Investing in index funds has been one of the best investments that you can ever make. Index funds are diversified, very cheap to get into, and oftentimes actually beat out all the other competition. Historically, index funds have consistently outperformed hedge funds and a bunch of mutual funds as well. I'm going to go over the top 3 reasons why I only invest in index funds and ETFs, and I've decided that it was a mistake and I've sold the majority of my stock positions in my investment portfolio. Let's hop onto the video. What's up guys, my name is Trevor, and on this channel we talk personal finance, investing. So if you're new to personal finance and investing, you'll find this content extremely helpful. Make sure you smash that like and subscribe button. Now let's hop onto the video. Reason number 1 why I only and strictly only invest into the S&P 500 and index funds in general is because, like I mentioned in the beginning of the video, they consistently beat out the competition. What competition am I talking about? I'm talking about large hedge funds from the top picks and mutual funds that are suggested by large finance influencers just like Dave Ramsey. The key word here is going to be consistently, because yes, mutual funds can beat out the S&P 500, and yes, hedge funds can sometimes beat out the S&P 500, but over the long run, let's say 10 years, index funds, and specifically I'm talking about the S&P 500, has consistently outperformed all the other funds while still maintaining a very cheap expense ratio. Have mutual funds and have hedge funds beat out the S&P 500? Answer is probably yes. But the other question is, not to speak, the passive ability of the S&P 500 is really what you should actually favor instead of actively managed funds like hedge funds. Because passive investing is much better than active investing. Anytime that I can get to enjoy my life and to do whatever I want, I'll take that, because my time is valuable and your time is valuable. We're all here to learn something and actually achieve something in our life. Alright, so the second reason why I only invest in index funds, and especially VOO, which is the S&P 500 Vanguard fund, is because of cost. Now Dave Ramsey, which is a very big finance guru, actually recommends people to invest into mutual funds. And if you don't know what mutual funds are, they are basically funds actively managed by investors. They proclaim to be smarter than beat out the S&P 500. However, majority of the times they actually don't. And if they do, what actually gets you is going to be the expense ratio. What the expense ratio is the cost to own and maintain that fund. Now, not all funds are created equally. Some mutual funds are actually fairly cheap compared to ETFs, and some are ridiculously expensive, like the ones that Dave Ramsey recommend are up to 1%. Now, you may be wondering, is 1% even that big of a deal? How cheap can a S&P 500 ETF cost? Well, the one that I highly recommend and the one that I'm currently invested in, and this is not financial advice of course, is VOO. VOO is the Vanguard S&P 500, which is a ETF with an expense ratio of 0.03%. And to give you some perspective, $10,000 is not too much money, to give you an example, because over a few years you can accumulate that much in terms of amount inside of your investment portfolio. 0.03% of that is going to be $3 worth of your $10,000 portfolio. However, if you were to take Dave Ramsey's advice, which is to invest in a mutual fund with an expense ratio of up to 1% or more, then that $10,000 investment will cost you $100 having that fund. It could be the S&P 500 in the short run. However, in the long run, the fee is going to eat up most of your returns. And it just really comes back to me saying that the more money you have invested in the stock market, the more I really urge you to go into index funds and ETFs of the low expense ratio. Because the more you have, the more the expense ratio will cost you. If you have $1 million, that 1% is going to be insane compared to if you were to just have index funds with only a 0.03%. It's still going to be expensive, but that's only because you have a large amount invested into the stock market. Alright, now we're on the very last reason why I decided to sell a majority of my stocks and buy index funds and ETFs only. Now before we get into this one, make sure if you really enjoyed this video, head down there and hit that red subscribe button. It really helps out the channel and it really helps boost the YouTube algorithm. And while you're there, hit that like button so it turns blue. It massively helps me out. Thank you so much. Alright, so Reason number 3 is going to be diversification. Diversification is actually very, very important, because if you were just to buy one single stock, how diversified are you? You are just investing in one single company, and the company goes bankrupt, or if it does bad in 1 year, your entire portfolio just literally dip. Now, if you're fine with that, then be my guest, just invest into a good stock. Something that I consider doing in the past is just buying only Apple or only Microsoft as a one stock portfolio. It seems insane, but Apple is something that I've been considering, just only buying Apple, since it has consistently, in the long run so far, beat out the S&P 500 while also getting great dividend returns as well. So Apple is something that I might consider heavily dumping more money into versus just buying VOO, which is the S&P 500. Now, onto diversification. There's so many index funds out there and so many ETFs that go over different sectors. If you're looking to invest into energy and you think energy will do well in the next 10 years, or if you're looking into tech stocks, or you're looking into real estate, bonds, whatever the sector that you're looking into, there's likely an ETF that's already out there ready for you. ETFs are so easy. You see all the funds that the pie or the ETFs consists of, and you can see exactly the returns over the last 5 years, 1 year. Now, obviously, the past returns don't equal future gains, and this is very important for you to understand as an investor, that the past returns don't necessarily mean it will do that in the next 5 years. It might do worse, or it can do a lot better. And it really depends on just the world or that specific sector that you're invested into. And overall, to wrap up, index funds and ETFs are just easy to invest in. I can recommend index funds to just anyone out on the streets. If they don't know anything about investing, I would recommend index funds. I can't recommend just buy individual stocks. Yes, it may seem more fun and it may seem like gambling to them. In a safe sense, and in the long run, index funds have proven to consistently beat out individual stocks, majority of individual stocks, and if we were to just pick a group of stocks and sectors to invest into. Remember guys, as a general rule, it does not matter how much you invest into the market and into the stock market. What matters is that you invest early and you still invest consistently. And what I mean by early is, it does not matter if you're 40 years old, you're 50 years old, it's not too late. You still have a long life ahead of you. Start investing today, because you should invest only solely for the future. This is why it's so important to invest early and consistently. You'll reap the rewards of compound interest. Now, we can talk about compound interest in another video, but those are two important things that you must get down. Invest early and consistently. All the best. Hope you guys enjoyed this video, and check out these 2 other personal finance and investing videos that will help you build your wealth in 2022 and beyond. Hope you found value in this video, and I'll see you guys in the next one. Take care.